Welcome to this week's edition of the InterMarket Analysis Update. This is being prepared June 12th, where we'll look at how things are in the market for Monday, June 13th. First of all, let's go back and look at some S&P 500 valuation. How are we doing with that? Well, with the declining week that we just had, we really came down in price. And in fact, we are below the trailing 12-month PE ratio. Stocks are still considered to be quite expensive, but at least we're coming back down to more of a fair value. Down on the bottom, this is the distance between the S&P itself and the red line. And you can see we've dropped slightly down below zero. Now, if we keep falling, we might get down to a trailing 12-month reading of 15. And if we really continue to fall, we'll get down to 10. If you look at this chart closely, you can see what that would mean as far as a point basis on the S&P 500. Now, these will adjust, and the market uses forward PE ratios. This is just looking back at the trailing 12-month PE ratios. Here's another chart showing how we're coming down in value, and then other points in market history where the market has really reacted and where it was in relation to the current trailing 12-month PE ratio. Now let's go in and compare some markets with each other. Here we have the Pure Growth Index, which is in a decline. This is the 200-day moving average, the red line. The blue line is a 50-period moving average, and we're having a hard time just getting back above the 50-period moving average. When we look at value, it's holding up better. It's in an uptrend, but had a really bad couple of days and has fallen below the 200-day moving average. When we compare the two, up on the top is growth, and it shows how it's been underperforming. On the bottom is value, and it shows how it has been outperforming. And we look at a number of different indexes and ETFs to look at growth versus value. Looking at the growth index against the value index on a ratio basis, this just shows that growth has really been underperforming. A complete inverse of that chart shows that value has really been outperforming. Growth is when the market really goes up, and those are the big stocks, the tech stocks, the ones that everybody loves to buy for a low price and then sell them at a higher price. When we're in a more defensive posture, that's when people tend to get more into value type investments. Not necessarily that they're going to go up, but oftentimes they go down less than the growth stocks. Also looking at the growth ETF against the value ETF based on the SPY, where growth had done a really good job for many years. Lately, we're just seeing a reverse of that. And here's an inverse, where value had been really underperforming. Well, in 2022, it continues to outperform. Looking at the growth index against the value index, another ratio, it just shows how growth has really been underperforming. Some index ratios. First, we look at the CRB index. This is a daily chart. Over here, it shows all the different components inside the CRB, and this is what we use to a large degree to measure inflation. The CPI came out on Friday, and it showed inflation as being very high. That didn't necessarily take us by surprise if you are continuing to watch the CRB index. On a comparative basis, for a long time, the CRB underperformed the S&P 500. Well, in 2022, the CRB is now outperforming the S&P. And here's just an inverse chart where the S&P had been going up. Now it's been going down. The NASDAQ 100 continues to underperform the S&P 500. The NASDAQ 100 are real growth stocks, the biggest stocks in the NASDAQ. The S&P does have a lot of growth stocks, but it also has a lot of value stocks. So on a relative basis, that's why the NASDAQ 100 has been underperforming. Looking at some other stocks, here's the S&P 100. These are the biggest stocks that make up the S&P 500, and they have really been underperforming the other 405 stocks that make up the S&P 500. Small caps, they've been hitting a hard time too, but they've been outperforming, and that could be positive for the market. A lot of times when we want to see some strength, first we look at small caps. They're considered to be more risky. They're usually not as established. Maybe they've been around a long time. They're just not as big. Well, on a relative basis, even though both have been going down, small caps have been doing better. people will also switch over to low volatility stocks or a low volatility ETF, such as this one, and it shows that this is still in an uptrend. Even though we've experienced some recent weakness, this has been performing better. On a relative basis, when we compare this with the S&P 500, the low volatility stocks were underperforming, but in 2022, they continue to outperform. Another really good measure of the overall market is called the Dow Jones Composite, and that takes the Dow, which are 30 stocks, the transports, and the utilities, and puts them together in one composite average. We are in a downtrend overall. We're below the moving average. The blue line has crossed below the red line, so it's a negative trend, and price is below both of the moving averages. We can also look at Dow theory. On the top, here's the Dow, where it's been having some real weakness recently. You can see there's a little bit of a divergence here. We're starting to break lower with the Dow, but the transports are actually breaking below what could be seen as support. That could be negative for the markets. Utilities have been doing quite well, but they've been really experiencing some weakness lately as well. The two main ones are the Dow and the transports. We look at utilities because they're closely tied to interest rates. Here's a longer term view of that same chart. And I point this out every time where we can look for divergences. But it doesn't always mean that we need to heed that. Back in 2015, 2016, we saw where the Dow was making a higher high. The transports did not confirm that. But after that, everything still kept going up anyway. So we want to be a little careful. Comparing stocks and bonds, this is an ETF put out by Vanguard, and it's just the total bond, all different maturities rolled into one. We have been really struggling based on price. As interest rates go up, that means bond prices are going down. And we hit some resistance not too long ago, and we're bouncing down below that. On another ratio basis, looking at the monthly chart, typically what has been happening from 2020, 2021, and into 2022 is even though stocks have been having trouble, bonds have been having even more trouble. So on a relative basis, stocks have been outperforming bonds. But lately, we're really seeing a turn down in stocks. When we compare bonds with stocks, over the long term, bonds have really underperformed and continue to do so, even though they're showing a little bit of strength right now. What we would want to see is this blue line to cross above the red line and then price begin to go higher. That would just show that bonds are now outperforming stocks, but we haven't done that for a long time. We also look at corporate bonds. There are treasury bonds, and then there are companies that put out bonds as well. There's an index that we look at, and it just shows it's been in an overall downtrend as well. They've been following down prices, up interest rates, just like treasury bonds have. When we look at the S&P compared to the 10-year yield, this just shows how the S&P has really been underperforming and continues to underperform as interest rates go up. Sometimes people will get into junk bonds. They're not happy with going with treasury bonds. They're not happy with dividends in the stock market. They're not really seeing any capital gains. They may be looking for some kind of a good yield. So they are willing to take on some more risk. And these are high yield or lower rated bonds. And we have dubbed the name junk bonds for them. They tend to follow the stock market. And for pretty much all of 2022, they have been in a downtrend. When we compare them to treasury bonds, they are still in an uptrend overall, but both are doing pretty poorly this year. Junk bonds and bonds have been really underperforming, but junk bonds are slightly in the lead. They are in an upward trend. And then up above, we have the S&P 500. Looking at some different sectors, comparing energy to the SPY, it had really underperformed for a long time. Well, it's been the place to be in 2022. This is your gas, your oil, your natural gas, all the different things that seem to be going up astronomically in price right now. Looking at the tech sector, that's where a lot of the growth stocks are. They really rolled over in 2022 and continue to be in a downtrend, and we're below the moving average. Semiconductors, which is not a sector but an industry group, they continue to be in a downtrend as well, and they are a large part of the growth area of technology. Comparing tech with the SPY, for a long time, tech was the place to be. on a comparative basis. They were really outperforming the S&P 500. Well, in 2022, tech has really struggled, even though the S&P has struggled also, but tech has struggled even more. Some other areas to look at: growth against bonds. Growth has really struggled and bonds have really struggled, but this is just showing that growth has struggled even more recently. It was kind of taking over, but we really fell down with the negative week we just had. Comparing the 10-year Treasury yield to tech, this just shows that as interest rates were coming down, they were underperforming and tech was outperforming. Now in 2022, interest rates are really outperforming the tech sector. Then looking at the 10 sector versus the 10-year, this shows how tech had really been doing quite well into late 2020 and into 2021, and then really into 2022. This is when we've seen a lot of weakness in tech. Staples, the things you have been outperforming discretionary, the things you might like to have, the fun things. And then here's an inverse of that, showing how discretionary has really underperformed staples. The energy sector against tech, it really underperformed for a long time, but in 2022, energy has been outperforming pretty much everything. Comparing gold to the S&P 500, gold is kind of struggling right now. The dollar seems to be showing some real strength as of late. But on a relative basis, even though gold is kind of staying about where it's at, the S&P has really been declining, so the ratio really spiked up. Comparing gold to the US dollar, gold is weaker than the dollar. The dollar's been holding up. Looking at the InterMarket Analysis chart, going back to the beginning of 2022, this just shows how oil is in the lead, followed by the dollar. Gold is up slightly. What's down on the year is stocks in the S&P and bonds, the blue line. Looking at some correlations, comparing the S&P 500 to the US dollar. The S&P is the black line and it's been going down. The US dollar is the dotted red line. It's been going up. And they have a pretty strong inverse relationship currently. Now, this changes all the time. But what we've been seeing over the last few days, as stocks have been going down, the dollar has been going up and vice versa. Comparing the S&P with the 10-year yield, interest rates have been going up, stocks have been going down, and that relationship is pretty strong as an inverse relationship right now. Comparing tech to the 10-year yield, yields have been going up, tech has been going down, so they're also having a pretty strong inverse relationship. The other one that we're watching quite closely is the 2-year yield. If you want to have more information about that, please watch one of the daily videos. I go into more detail with that. The S&P has really been struggling. The 2-year yield has been just spiking. It's up over 3%. So we're seeing the S&P go in one direction and interest rates go in the other direction, so they have a pretty strong inverse relationship. If you watch any of my videos, I pretty much show this all the time. The things that are positive right now, it hasn't changed if you've watched any of these videos before. Energy, the CRB index, gold, interest rates, and staples. Those are holding up the best right now. I'm not going to read this next list off because it just goes on and on and on. Pretty much anything to do with bond prices, stock prices, cryptocurrency, tech-based ETFs, all of those are struggling right now, and all of the different indexes, whether they're smaller like the Dow that only has 30 stocks, or you have the Wilshire, which is called the Wilshire 5000, but I believe it has 1,500 stocks. So thank you. I hope that you enjoyed this. I hope you find this helpful. I try to prepare this video every week. Nothing has really changed over the last few weeks. We're going to have to see a real shift in the overall climate for a lot of the intermarket analysis charts to change. So we're just kind of updating what we already knew. And yes, I'm trying to run this out a little bit so that when I put the end cards up on YouTube, it doesn't cover the data that I was just talking about. So I get to talk for a few extra seconds and just let this run a little bit longer.